Topic examines the structure of fixed income cash flows and the diverse types of bonds available in financial markets. Fixed income instruments differ primarily in the timing, amount, and certainty of their cash flows. Traditional fixed coupon bonds provide investors with periodic interest payments and repayment of principal at maturity. These predictable payments make such securities attractive to investors seeking stable income and relatively lower risk. However, issuers and investors often require more flexible financing arrangements, leading to the development of alternative bond structures with varying cash flow characteristics. Understanding these structures is essential for evaluating investment suitability, pricing, risk exposure, and expected returns. Fixed-rate bonds are among the most common fixed-income securities and provide a constant coupon payment throughout the life of the bond. Because the coupon remains unchanged regardless of market interest rates, the bond's market value fluctuates inversely with prevailing yields. Investors favor fixed-rate bonds when interest rates are expected to decline, as locked-in coupon payments become relatively more attractive. Conversely, issuers may prefer fixed-rate financing when rates are low and expected to rise in the future. The stability of contractual cash flows simplifies valuation and portfolio management, making fixed-rate bonds a benchmark instrument within global debt markets and a fundamental component of fixed-income investing strategies. Floating-rate notes, commonly called FRNs or floaters, offer variable coupon payments tied to a market reference rate plus a quoted spread. The reference rate may be linked to short-term benchmarks such as SLFR or interbank lending rates. Because coupon payments adjust periodically to reflect changing market conditions, floating-rate securities exhibit lower price sensitivity to interest rate movements compared with fixed-rate bonds. Investors often use FRNs to reduce duration risk in rising interest rate environments. Issuers may benefit because floating-rate financing can initially provide lower borrowing costs. However, increasing benchmark rates can raise future interest expenses for issuers, creating uncertainty in debt servicing obligations over time. Zero-coupon bonds represent another important fixed-income structure. These securities do not provide periodic coupon payments. Instead, investors purchase them at a discount to face value and receive the full par amount at maturity. The investor's return comes entirely from the appreciation of the bond's price over time. Zero-coupon bonds eliminate reinvestment risk because no interim cash flows must be reinvested. However, they exhibit greater price volatility than coupon-paying bonds of similar maturity because all cash flows occur at the end of the investment horizon. These instruments are commonly used for long-term financial planning, pension obligations, and education funding due to their predictable maturity value. Deferred coupon bonds delay the start of regular interest payments until a specified future date. During the deferral period, interest may accrue and compound, eventually being paid alongside later coupon payments. These bonds are useful for issuers undertaking projects that will not generate immediate revenue, such as infrastructure developments or large-scale industrial investments. Investors typically demand higher yields because of delayed income and increased uncertainty. Deferred coupon structures provide issuers with temporary cash flow relief during early project stages while still enabling access to capital markets. In practice, zero-coupon bonds can be viewed as an extreme form of deferred coupon bond because all payments occur at maturity. Inflation-linked bonds are designed to protect investors against inflation risk by adjusting coupon payments or principal values according to changes in a specified inflation index. Treasury inflation-protected securities, or TIPS, are a common example. In capital index structures, the bond's principal increases with inflation, causing coupon payments based on that principal to rise as well. This structure preserves the real purchasing power of investors' cash flows over time. Inflation-linked bonds are particularly valuable during periods of rising prices and uncertain monetary conditions. They also provide issuers with access to investors seeking inflation protection, thereby broadening the range of financing instruments available in fixed-income markets. Topic also highlights contingency provisions embedded within bond contracts. Embedded options provide rights to issuers or investors if specific conditions occur. Callable bonds benefit issuers because they can redeem bonds before maturity when interest rates decline. Putable bonds benefit investors by allowing early repayment if market conditions deteriorate. Convertible bonds provide investors the opportunity to exchange bonds for equity shares. These embedded features significantly influence valuation because they alter expected cash flows and risk exposure. Investors typically require compensation through higher yields when provisions favor issuers, while bonds offering investor protections may accept lower yields due to reduced uncertainty and enhanced flexibility. Legal, regulatory, and tax considerations also affect fixed-income cash flows and trading activity. Tax treatment differs across jurisdictions and may influence investor demand for certain securities. For example, The increase in value of zero-coupon bonds may be taxed annually as imputed interest income even though no cash is received before maturity. Regulations may impose disclosure requirements, credit standards, or limitations on certain bond structures. These factors affect issuance costs, market liquidity, and investor returns. Consequently, analysts must evaluate not only contractual cash flows but also the broader legal and regulatory environment surrounding fixed income instruments when assessing their suitability, valuation, and long-term investment performance.